Hey everyone, welcome to another deep dive with us.
Yeah.
Today we're tackling,
I like that tackle.
well, we're going to be tackling a lot of stuff, I think, today.
Yeah.
But in a good way, in a fun way.
Yeah.
This is The Little Book of Common Sense Investing by
Yes.
John C. Bogle.
Legendary John C. Bogle.
And I think we all know John C. Bogle.
Yeah, well, he's the founder of Vanguard.
Right.
And he is well known for creating the first index mutual fund.
Exactly. So this is a classic, I think, in the world of investing.
It is. Well,
And it's one that I think a lot of people refer back to as kind of their Bible of investing.
Yeah.
And for good reason.
yeah.
Yeah.
So he really lays out some clear and compelling arguments in favor of this really simple but powerful approach to investing.
Yeah. And so, I mean, is this book for everyone?
I think so.
Okay.
I mean, I think regardless of whether you're just starting out with investing or you've been doing it for years,
Yeah.
there are some really valuable insights
Yeah.
in here.
Yeah.
And I think a lot of it has to do with just kind of cutting through the noise, all the noise that we hear from Wall Street,
Yeah. All the hype.
all the hype, and just focusing on what really matters, which is building wealth over the long term.
Yeah. And so this is a deep dive all about index funds.
Yes.
And I think that's really kind of the core of the book.
It is. It's the heart of his philosophy.
Yeah. So why don't we just jump right into that then?
Yeah, let's do it.
I mean, what is it about index funds that is so appealing to John Bogle?
So his core idea is that owning the entire stock market through a low-cost index fund is the smartest strategy.
Okay.
It sounds almost too simple, right?
Yeah, it does.
But
Yeah.
think about it this way. By doing that, you're essentially capturing the returns of all publicly held U.S. businesses.
So instead of trying to pick winners and losers, you're kind of betting on the entire
Exactly.
growth of the economy.
And history shows that over the long term, the market tends to go up. Now, of course, there will be ups and downs along the way, but by owning the whole market, you're riding that wave of growth.
Yeah, that makes sense.
So you-
Especially if you're in it for the long haul.
Yeah, and think of it like owning a slice of every successful business out there.
Oh, I like that.
You know, instead of trying to pick and choose which ones you think are going to do well, you're just saying, I'm going to own a piece of all of them.
So is it just about the fact that it's simpler?
Well, it's definitely simpler,
Yeah.
but it's also about diversification,
Okay.
right? You're spreading your risk across thousands of companies instead of putting all your eggs in one basket or even a handful of baskets.
That makes a lot of sense.
And when you diversify like that, you're reducing the impact of any one company's performance on your overall portfolio.
Right. So even if one company goes belly up,
Exactly. Your whole portfolio isn't going to tank.
right, exactly.
And it's not just about avoiding risk either. Bogle argues that by owning the entire market, you're actually capturing virtually all the returns that the market generates, both from dividends and from the earnings growth of those companies.
So this is kind of a fundamental, like, almost like,
Yeah, it's like a bedrock principle.
yeah, principle, yeah.
And it's really powerful when you think about it.
And so, I mean, this idea of owning the entire market through an index fund is it almost seems,
Seems counterintuitive.
yeah, because we're always told to try to beat the market.
Right. We're told to find those hidden gems or time the market perfectly. But Bogle says that's a fool's errand.
Really?
Yeah, he makes a very compelling case that trying to beat the market is actually a loser's game.
Okay, so this is a contrarian approach.
It is, but it's backed by a lot of data and research.
Okay.
And I think that's what makes his argument so compelling.
So let's dig into that a little bit. I mean, why is trying to beat the market a loser's game?
Well, for one thing, you're playing against incredibly skilled professionals
Okay.
who have access to tons of data, sophisticated algorithms, and years of experience.
Yeah.
You know, these are people who do this for a living. And then there's the cost of trading.
Yeah.
Things like brokerage fees, fund expenses, and taxes. All those things eat away at your returns.
So even if you manage to pick some winners, a lot of those gains could get eaten up.
Absolutely.
By
Fees. And Bogle actually points out that the most active stock traders,
yeah.
while they might earn decent returns, often lose a huge chunk of their gains to trading costs.
Yeah, I think I've even read some of the stats on that.
Oh yeah, he cites a study
And they're pretty...
where active traders lost about 2/3 of their gains to these costs.
Wow, 2/3.
Yeah, that's crazy.
That is crazy.
It really highlights the hidden costs of trying to beat the market.
Yeah, and I think that's something that a lot of people don't realize.
They focus on the potential gains, but they don't factor in the almost guaranteed costs that come with active trading.
I mean, it makes sense if you think about it. The more you trade, the more you're paying in fees.
Exactly.
And so is that why so many people fall short when it comes to investing?
I think it's definitely a big part of it.
Okay.
But there's also this allure of finding that hidden gem, that stock that's going to skyrocket in value.
Right.
It's like striking gold.
And the media loves to talk about those stories.
Oh, yeah. They love to hype up those stories of individual investors who made a fortune overnight.
Yeah.
It feeds into that fantasy that anyone can become a Wall Street wizard.
Yeah. And of course.
Which, maybe some people can.
Some people can.
But it's definitely not the norm.
Yeah.
And then there's the whole industry of financial advisors and stock pickers who promise to help you beat the market.
Yeah.
It's easy to get sucked into that idea that someone else has a magic formula.
Especially when you see like the ads on TV.
Oh, yeah. The ads, the talking heads on CNBC.
Exactly.
Promising you riches.
It's tempting.
It is very tempting.
But the reality is, even the pros, those highly paid fund managers,
the so-called experts,
rarely beat the market consistently, right?
It's true.
Yeah.
Studies have consistently shown that very few fund managers are able to outperform a simple index fund over the long run.
Wow. And especially after you factor in their fees.
Especially after fees?
Right.
That's the kicker.
So you're paying them all this money.
Yeah.
And then they're underperforming the market.
And you could have just bought an index fund and done better.
Yeah. I mean, it's
mind-boggling.
It's mind-boggling, yeah.
But I think it just goes to show that the market is really efficient. And it's very difficult to consistently outsmart it.
I mean, it's almost ironic, right?
It is.
You're paying these professionals
to
try to beat the market, and then you end up underperforming.
And they're getting rich while you're not.
While you're potentially losing money.
Yeah, it's a sad state of affairs.
Yeah, so this is where I think Bogle's solution, which is the index fund, really comes into play.
It's the great equalizer.
Yeah. So can you explain exactly how an index fund works for those who might not be familiar?
Sure. So an index fund is simply a type of mutual fund or exchange-traded fund, also known as an ETF, that tracks a specific market index.
Okay.
So, for example, if you buy an S&P 500 index fund, you're essentially buying a tiny piece of all 500 companies in that index.
So it's like a prepackaged portfolio that automatically gives you diversification.
And because index funds are passively managed, meaning they're just tracking an index, their fees are incredibly low.
Oh, okay.
This is a huge advantage.
Right, because we just talked about fees.
Yeah, and how much they can eat into your returns.
Yeah.
So with an index fund, you're keeping more of your money working for you.
And so is that essentially Bogle's argument?
Yeah. I mean, he's saying instead of trying to be smarter than the market, we should aim to be the market.
Be the market.
Yeah, by owning the whole thing.
That's interesting.
Through an index fund.
I've never thought about it that way.
Yeah, it's a shift in perspective. And by doing so, we align ourselves with the long-term growth of the economy.
Okay.
We benefit from the power of compounding, and we keep our costs super low.
Okay, so, I mean, this is starting to make a lot of sense to me, but I do have one question.
Okay.
What about the risk that some companies within an index fund will inevitably fail?
That's a great question.
Yeah, I mean...
And one that Bogle addresses head on.
Okay.
So while it's true that individual companies can and do fail, the overall market tends to grow over time.
So it's kind of like having faith in the overall...
It's about believing in the resilience of the market.
Resilience and growth of the market as a whole.
It's exactly. And understanding that while there will always be fluctuations in the short term, over the long term, the market has consistently trended upwards.
Yeah. I mean, if you look at a historical chart of the stock market, it generally goes up over time.
It's a staircase with some wobbly steps along the way.
Exactly.
But the general direction is up.
Yeah. So by owning the entire market through an index fund, you're kind of participating in.
We're participating in the success of those companies that thrive and innovate, even if some others falter along the way.
Right. You're kind of spreading.
Yeah, you're not putting all your eggs in one basket.
Exactly.
So even if one company goes bust,
yeah,
it's not going to drag down your entire portfolio.
Which is comforting.
It is.
Yeah, because I think a lot of people are afraid of investing
Yeah.
because they think it's too risky.
Right. They think they could lose everything.
Yeah.
But Bogle's approach is
Yeah.
all about minimizing that risk
Okay.
through diversification
I-
and a long-term perspective.
So this is kind of shifting your mindset from trying to get rich quick to building wealth.
Building wealth slowly and steadily. Over time.
Yeah.
And I think that's a really powerful concept.
Yeah, I mean, it's not as sexy as trying to...
Yeah, it doesn't make for good headlines.
Yeah, find the next Apple or Tesla.
Right.
But it's probably a lot more sustainable.
It is.
And a lot less stressful.
Yeah, and ultimately more rewarding.
Yeah, because you're not constantly...
You're not constantly checking your portfolio
Yeah.
and stressing out about every little market fluctuation.
So he does talk about the financial system as a whole.
Oh, yeah.
And he has
He's not afraid to pull back the curtain.
No, he doesn't.
And reveal some of the less savory aspects of the industry.
I think he actually uses the analogy of a casino.
He does.
Which is a bit unsettling, to be honest.
It is. It's a powerful analogy, though.
Okay.
Because it really highlights the fact that Wall Street isn't always playing on your team.
Right.
You know, they're there to make money.
Yeah.
And often at the expense of investors.
So he's saying that we need to be aware...
Yeah, we need to be savvy.
...of the games.
Yeah, the games that are being played. And how to protect ourselves.
I think he estimates that investors are paying something like $400 billion each year.
Yeah, that's a crazy number.
Yeah, in fees.
Fees, commissions,
all that stuff.
All the expenses associated with the financial system.
So this is a huge amount of money.
It is.
That's basically being siphoned away.
Siphoned away from investors. And it's a number that's likely even higher today.
Really?
Than it was when he wrote the book.
So what can we do about it?
Well, Bogle's advice is simple.
Okay.
Embrace simplicity. Choose low-cost investments, and be wary of anyone who promises to beat the market.
Okay, and I think we'll dig into those ideas a little bit more in the next part of our deep dive.
Yeah, absolutely.
But I think this is a good place to kind of pause for now.
Yeah.
And let those ideas sink in a little bit.
Let them marinate.
Yeah, let them marinate, and we'll come back.
We'll be back,
and we'll talk about the specifics.
The nitty-gritty.
Of how to actually choose.
Yeah, how to put this all into practice.
Index funds.
Exactly.
And build a portfolio.
Your own personalized index fund portfolio.
That aligns with your goals.
Yeah.
So stay tuned for that.
We'll be right back.
Okay, so we're back.
We are back.
And we're ready to dive into the actual, like, how to...
nitty-gritty.
The nitty-gritty.
The practical stuff.
Of building a portfolio with index funds.
Yeah. How do we actually put all this into practice?
Yeah, because it's all well and good to talk about.
Yeah, the theory.
The philosophy. Yeah. But at the end of the day...
Yeah, you got to actually buy some fun.
You got to do it.
Yeah.
So where do we even begin?
So remember how we talked about starting with a broad market index fund as your foundation?
Yeah.
That's step one. Think of it as the cornerstone of your investment strategy.
So like the S&P 500 like we talked about earlier.
Yep, that's a great example.
Okay.
It gives you instant diversification across 500 of the largest U.S. companies. So you're capturing a significant portion of the market's overall return.
Okay.
Bogle actually calls this owning the stock market.
Owning the stock market.
Yeah, because you're essentially buying a tiny piece of all those companies.
Yeah, it is pretty cool.
Yeah, it's a powerful concept.
Yeah.
And it's a great way to start building your portfolio.
Okay. But there are a ton of other index funds out there, right?
Oh, yeah. There are tons, like ones that track
different parts of the market.
Different sectors.
International markets. Yeah, you name it.
So does Bogle recommend branching out?
He does.
Beyond just the S&P 500.
Yeah, once you've got that solid base.
Okay.
In a broad market fund. He suggests exploring index funds that align with your specific risk tolerance.
And investment goals.
So if I'm feeling a little bit more risky, I can go for something.
Yeah, maybe you're bullish on emerging markets.
Okay.
Or you think there's huge growth potential in renewable energy.
Okay.
You can find index funds that target those specific areas.
Interesting.
And add them to your portfolio.
So you're kind of creating your own little...
Your own personalized market pie.
Your own market pie.
With all the slices that you find most appetizing.
Okay, I like that.
Yeah.
But even within those categories, like broad market sectors, international,
right,
there are still a lot of different index funds out there.
There are. And that's where Bogle's next piece of advice comes in.
Which is?
Costs.
Costs.
Yeah, he's adamant about this.
Okay.
Every dollar you pay in fees and expenses is a dollar that isn't working for you, that isn't compounding over time.
It's a leak in your bucket.
It is, exactly.
Yeah.
And those seemingly small percentages can really add up and make a huge difference in your long-term returns.
So how do we compare costs when we're looking at these different index funds?
So the key number to focus on is the expense ratio.
Okay.
It's basically the annual percentage fee charged by the fund to cover its operating costs.
Okay.
And the beauty of index funds is that because they're passively managed, their expense ratios tend to be super low.
Okay, so lower is better.
Always lower is better when it comes to expense ratios.
Okay.
Absolutely.
Can you give me an example of how much of a difference this can actually make?
Sure. Let's say you invest $10,000 in a fund with an expense ratio of 0.1%.
Okay.
That means you'll pay $10 in fees per year.
Okay.
But if you invest in a fund with an expense ratio of 1%, you're looking at $100 in fees per year.
Wow, that's a big difference.
That's 10 times more.
Yeah.
And over time, that difference can really compound.
Literally compound.
Yeah, pun intended.
Yeah.
But seriously, it can have a significant impact on your returns.
Yeah, those seemingly small percentages can really add up.
They can.
Yeah.
That's why Bogle is so passionate about keeping costs low.
And I think this is where his own company, Vanguard, really shines.
They are known for having some of the lowest expense ratios in the industry.
Yeah, which makes sense.
Yeah, it's a testament to his commitment to putting investors first.
Okay, so we've got broad market exposure, low cost, diversification. Anything else we should be thinking about when we're evaluating these index funds?
So Bogle also encourages investors to consider tax efficiency.
Okay.
Especially if you're investing in a taxable account.
Right.
Some index funds, particularly those that track a narrow slice of the market, or trade frequently, can generate higher taxable distributions.
And that can eat into your returns.
Exactly. So it's something to be aware of.
So tax implications are something to keep in mind.
Definitely.
Okay.
It's all part of being a savvy investor.
All right. So we're diversifying. We're keeping costs low. We're being mindful of taxes. I feel like we're getting a good handle on this.
I think so.
But Bogle also talks about some common pitfalls.
Oh, yeah, he does.
That investors fall into.
Even when they're using index funds.
Right. So even if we're doing all the right things, there are still traps out there.
There are. And it's easy to fall into them.
Yeah. So let's talk about those.
Okay.
Because I definitely don't want to fall into any traps.
No one does.
No.
So one of the biggest mistakes investors make is chasing past performance.
Okay.
You know, we're all drawn to those investments that have been on a hot streak.
Yeah. We want to get in on the action.
Right. But Bogle warns that past performance is not a reliable indicator of future results.
Okay, so just because something has been doing well doesn't mean it's going to continue to do well.
It could be a sign that it's overvalued.
Right.
And about to come crashing down.
So we need to resist that temptation.
Yeah, it's tough.
To jump on the bandwagon.
But it's crucial
Yeah.
for long-term success.
So we're being contrarian again.
We're going against our natural instincts.
Okay.
But we're doing it for a good reason.
Yeah, because we're trying to build wealth.
Exactly.
Not just get lucky.
Right.
Okay. What other traps should we be aware of?
So Bogle also cautions against relying too heavily on investment advisors or brokers who often have their own agendas.
Right.
You know, they might be pushing products that earn them higher commissions or fees, even if those products aren't the best fit for your needs.
So it's that classic conflict of interest.
Yeah.
Yeah.
They're looking out for their bottom line.
Yeah.
Not necessarily yours.
So how do we know who to trust?
That's a tough one.
Yeah.
I mean, Bogle encourages investors to be really skeptical of anyone who promises easy returns or claims to have a system that can consistently beat the market.
Yeah. If it sounds too good to be true.
It probably is.
It probably is.
Yeah.
So it's about doing your own research.
Absolutely. And taking ownership of your investment decisions.
Okay. So we're not just blindly following the advice of others.
You're in the driver's seat.
You're
the captain of your own ship.
Okay.
You make the decisions.
I like that.
Yeah.
All right. What else?
So another pitfall that Bogle points out is the allure of complexity.
Okay.
He argues that many investors are drawn to complicated investment strategies.
Yeah.
Or products that seem sophisticated or exclusive.
Yeah.
Like hedge funds or private equity.
Yeah.
But Bogle is saying that simplicity is key.
Simplicity.
Keep it simple, stupid.
KISS.
Yeah, the
Ooh.
KISS principle.
Okay.
It applies to investing as well.
So instead of getting caught up in all the fancy jargon
Yeah.
and the complicated strategies,
Let's focus on the basics.
we should just stick to
Diversification,
low costs
long-term growth.
and long-term growth.
Those are the core principles.
Okay.
And they'll serve you well.
I like that. All right, so we're keeping it simple.
Yeah.
We're avoiding complexity.
Okay.
Anything else?
So along those lines, Bogle also stresses the importance of patience.
Patience.
Yeah. Building wealth takes time.
Okay.
It's not a get-rich-quick scheme.
Mm-hmm.
It's about resisting the urge to constantly tinker with your portfolio
Okay.
or chase quick returns.
So this is where I tend to struggle.
I think a lot of people do.
Yeah. It's so tempting to try to time the market
Yeah.
or jump on a hot stock tip.
Right.
But Bogle is saying we're better off
Just tuning out the noise.
tuning out the noise.
Yeah, and staying the course.
Staying the course.
Trusting in the process.
Okay, so we're being patient.
Patient.
We're trusting the process. We're
Yeah.
not trying to time the market.
Don't try to time the market.
Don't try to time the market.
You'll almost always get it wrong.
All right. I'll try to remember that.
Oh, good.
So I think this is a good point to maybe address a question
Yep.
that I'm sure is on a lot of people's minds.
Yeah, what's that?
Is Bogle saying that all active management is bad?
No, not at all.
Okay.
He's not saying that all financial advisors are untrustworthy.
Yep.
He's simply advocating for a more sensible
Okay.
and cost-effective approach to investing.
I see.
You know, he's a champion for the everyday investor.
Mm.
He wants to empower people with the knowledge and tools to navigate the complexities of the financial world
Okay.
and make informed decisions.
So he's not demonizing the entire industry.
No, he's just trying to make it better
Okay.
for everyone.
I like that.
Yeah,
So it's about leveling the playing field
exactly.
and taking control of your financial future.
You got it.
Okay, so while his primary focus is on index funds,
Yeah.
I feel like a lot of his principles could be applied to any investment strategy.
Yeah, it's about shifting your mindset,
Okay.
understanding how the market works, being mindful of costs, and having a long-term perspective.
It's about being a smart investor.
Yeah.
No matter what your strategy is.
Exactly.
Okay. I think that's a really valuable insight.
I think so too.
Yeah.
And it's one that I think everyone can benefit from.
Okay, so we've identified some common pitfalls.
Yeah.
We've talked about the importance of minimizing costs.
Uh-huh.
And we're starting to understand why Bogle is such a champion for index funds.
Right.
But let's get even more specific.
Okay.
How do we actually choose specific index funds
The right ones.
to build our portfolio?
So that's the next piece of the puzzle.
Okay.
And luckily,
Yeah.
Bogle provides a really clear roadmap
Okay.
for choosing the right index funds
Okay.
to align with your investment goals and risk tolerance.
All right, I'm ready for that roadmap.
Let's do it.
Okay, so we're back and ready to put all this knowledge about index funds into action.
Yeah, let's build a portfolio.
All right, so we know that we're supposed to start with a broad market index fund.
Right. That's the foundation.
Okay, so something like an S&P 500 index fund.
Exactly. That's
Yeah.
a great example. You're instantly diversified across 500 of the largest U.S. companies.
Oh, and Bogle calls that owning the stock market.
He does. It's a powerful concept.
But I'm guessing there's more to it than just picking any old S&P 500 index fund.
You're right. There are different types of index funds that track various market segments,
Okay.
both in the U.S. and internationally.
So once I've got my S&P 500 index fund, I can start looking at other options.
Exactly. Once you have that core broad market holding, you can add layers of diversification.
So if I want to add some international exposure, how do I choose the right fund?
Bogle suggests looking for funds that track broad international indexes,
Okay.
like the MSCI EAF index,
Where?
which covers developed markets outside of the U.S. and Canada.
So I'm looking for a broad-based international index fund with low costs.
Right. But you also need to consider currency risk.
Currency risk, what's that?
It's the risk that changes in exchange rates will affect your investments.
So if the euro weakens against the dollar, my investment will be worth less.
Exactly. Even if the company's stock price is going up.
Is there anything I can do to mitigate that risk?
Some international index funds are hedged against currency risk,
Okay.
meaning they use financial instruments to offset those fluctuations.
So I need to consider currency risk and maybe look into hedging options.
Exactly.
Oh.
It's all part of being a savvy investor.
Okay, this is a lot to take in.
It is, but it's worth it.
Yeah, I mean, this is our financial future we're talking about.
Right. And remember Bogle's core message.
Which is?
Keep it simple.
Okay.
Don't overthink it.
Right.
Stick to the basics.
I can do that.
I think so.
I have to admit, though, a part of me still wonders if I'm missing out by not picking individual stocks.
I understand that feeling.
Yeah.
It's tempting to think we can beat the market,
Yeah.
but Bogle's research shows that it's very difficult to do so consistently.
So the odds are stacked against us.
They are, especially over the long term.
So what you're saying is don't play the game, own the game.
Exactly. Shift your mindset from trying to beat the market to participating in its growth.
I like that.
It's a much more sustainable and less stressful approach.
Okay, so we're minimizing our risks, maximizing our returns.
Right, and putting ourselves in a strong position to achieve our financial goals.
This has been such an insightful deep dive into Bogle's world.
It has. He's a brilliant guy.
He is, and he's made investing so much more accessible.
Definitely. He's a champion for the everyday investor.
So what's the one key takeaway you want our listeners to remember?
Investing doesn't have to be complicated or risky.
Okay.
It's about making informed choices, being patient, and trusting in the long-term growth of the market.
And by following Bogle's principles, we can all become winners in the game of investing.
Absolutely. He's given us the roadmap to financial success.
Well said. That's it for our deep dive into the Little Book of Common Sense Investing.
We hope you enjoyed it.
Remember, investing is a journey, not a race. And with the right knowledge, you can achieve your financial dreams.
See you next time.